This is Kurt Heisinger, accounting professor at Sierra College and author of Managerial Accounting. This video describes how to create the three budgets that are associated with production costs, and you see those three production costs below. We've got direct materials, direct labor, and manufacturing overhead. All of those are associated with production, and we're going to take a look at how to create each of these three budgets in this video. Let's start by looking at the direct materials purchases budget. So what does it do? What does it tell us, this direct materials purchases budget? And again, we're in a manufacturing environment. It provides an estimate of the raw materials that we need, whatever materials we need to achieve a desired level of production. And the starting point for the direct materials purchases budget is the number of units of finished goods to be produced each quarter. And I have a separate video on how to put together the sales budget and the production budget, and this comes from the production budget, the finished goods to be produced each quarter. All of the videos that I have related to operating budgets are linked and related to the same company. So if you'd like to see where the starting point comes from, take a look at the sales and production budget video. The direct materials purchases budget, our focus here, answers the question, how much material must be purchased during the period to meet production needs, and then what will it cost? And that feeds into the cash budget that we talk about in a separate video. So the question we're trying to answer here is, how much material do we have to purchase during a period, and we're using quarterly periods, to meet our production needs? Well, let's take a look at how we put this together. I'm going to walk through this direct materials purchases budget, but realize that the footnotes will provide a lot of information that will answer most questions that crop up when students look at the direct materials purchases budget. So I'll go through this budget, but realize you can pause it at any point and take a look at those footnotes and tie them back to the information in the budget to see where that information comes from. You'll notice that the direct materials purchases budget, that's what we're looking at here, the direct materials purchases budget is for the year ending December 31, and we've broken it out into four quarterly periods. So here is the first period right here, the first quarter, and then the second quarter, third quarter, and fourth quarter. So when we're talking about quarterly periods, we're talking about 3 months, or a quarter of a year. And since this fiscal year is the same as the calendar year, the first quarter that you see right here is for January 1st through March 31st, for those 3 months. It starts on January 1st. Let me just walk through then each of the line items that you see here. I'm going to start by looking at the second quarter. Let's just take a look at the second quarter. We're going to start this first line with the units that need to be produced. And again, that comes from the production budget. So for the second quarter, we determined that in a separate video that we need to produce 49,200 units in the second quarter. What we're trying to get at here is, what do we need in the way of materials to make that happen? We've also determined in a separate video that the materials required per unit will be 2 pounds. So if you take 2 pounds times the 49,200 units, you're going to get the 98,400 pounds. So once you get to this third line, we're now talking about pounds of material rather than units of production, finished units of production. And you'll see what our needs are for each quarter. However, we're going to have some desired ending inventory. We're not going to just go out and buy exactly what we need. We want to have a little extra just in case we need more. So we're going to have a desired ending inventory, and you'll see that with this second footnote, you'll see the information that tells you where we get that. So I'm not going to go through that in detail, other than to say that we figure we're going to need 20% of next quarter's production needs in the current quarter as our desired ending inventory, materials inventory. And then the 20% times the 98,400 gives us that number. So I just outlined where these numbers come from, the desired ending inventory. Then we add our desired ending inventory to the materials needed in production, and that gives us the materials needed in inventory. So since the second quarter is a little bit messy here with all of the markings, let's go to the third quarter just to give you an example. What you see here then is materials that we need in production, 118,400, and we're going to add our desired ending inventory. Remember that that's 20% of next quarter's materials needed in production, so that comes from that 20% of 102,400, and that gives us this right here, the 20,400 480. We're going to add that to the 118,400, and that gives us the 138,880. So the materials needed in inventory for the third quarter is 138,880 pounds. Remember, we're in pounds here. And then we're going to deduct from that our beginning inventory, and that's what this arrow is all about here. It comes from the ending inventory from the previous quarter. So we're going to deduct that 23,680 pounds, and that tells us exactly what we need to buy. So that's this right here. For the third quarter, we need to purchase 115,200 pounds of direct materials. This is very important for our purchasing department. They need to know how much to purchase, and negotiating with our suppliers, how much to purchase each quarter. And then remember, the second step is to figure out the cost of these materials. So and the assumption in this example is that it's going to cost $1 per pound. That comes from, again, our purchasing department, that estimate. So we're going to multiply it times $1 per pound, and that's going to give us the cost of materials that we expect for the third quarter of 115,200. One last thing to point out, just briefly, related to the very last column, and I kind of go through this same idea, the same concept when I talked about our production budget, so you can go take a look at that if you want a few more details on this. But the key is where do these numbers come from for the year? Well, the 400,800 comes from the 200,400, which is just a sum across quarters, times 2 pounds per unit. So it's 400,800 pounds of material needed in production for the year. This 20,000 just comes from the end of the fourth quarter. You see the arrow there, and we add that to the 400,800, and that gives us 420,800. The beginning materials needed, the beginning inventory, comes from the beginning of the first quarter. January 1st is the beginning of the first quarter. It's also the beginning of the year, so it's that same number, 16,320, and we subtract that from 420,800 to get the direct materials to be purchased of 404,480. And again, take that times $1 per pound in this example, and that gives us the cost of the materials that we expect to purchase for the year. And one last item here is the direct materials cost per unit. That $2, if we want to establish that $2, you can look at the footnote. It's simply the $2, that's what we're looking at here, the $2 is simply the 2 pounds of materials required per unit times the $1 per pound. Those are the standards that we established for direct materials. Now we're going to take a look at the direct labor budget and describe what this budget tells us. So first of all, it provides an estimate of the direct labor hours and the related costs that we need to achieve our desired level of production. And that desired level of production, again, comes from the production budget, and that's in a separate video. It's the second, the direct labor budget is, it's the second of the 3 supporting production budgets. Here's an example of the direct labor budget for the same company that we've been talking about with all of the operating budgets. And what we're looking at here, it's actually quite a bit simpler than the direct materials purchases budget because we don't inventory direct labor. We start here with the units to be produced. That comes from our production budget, separate video, and you'll see those numbers. We multiply it by the standard number of direct labor hours per unit, and that's 0.1. And that gives us the direct labor hours that we need in production. And this is really helpful for our production group, our production manager, because we have to schedule labor hours. We want to make sure we have enough folks there, enough employees working to be able to provide those labor hours that we need. So this gives us a chance to plan for that. That's why we put these budgets together. And you'll see in the first quarter, we need 4,080 hours. In the second quarter, we need 4,920 hours. In the third quarter, we need 5,920. In the fourth quarter, 5,120. And you'll see that it kind of ramps up from the first quarter to the second quarter to the third quarter, and we are going to need to plan for that. We're going to need to get more employees in place to be able to take care of the production needs of direct labor hours. And then we convert that to cost by multiplying it by our average labor rate per hour, which is $13. That's the standard that we set. So we'll take that $13 per hour, multiply it by the number of hours, and for the first quarter, that gives us a direct labor cost of $53,040. That's the 4,080 hours times the $13 per hour. And the summary of this is shown over here for the year. And notice that we also, over here for the year, show the direct labor cost per unit. And that is simply the $13 per hour. That's the standard that we set, that we expect to pay our employees, and times that, multiply that by the direct labor hours per unit of 0.1. So 0.1 times 13 means that our expected direct labor cost per unit is $1.30. The last budget that we're going to look at related to production is called the manufacturing overhead budget. And this budget provides an estimate of all the production costs outside of, other than, direct materials, direct labor, and direct labor, I should say. And these are the production costs outside of those two areas that are necessary, again, to achieve our desired level of production, and that comes from the production budget. We usually will separate our overhead costs into variable and fixed components, so we're going to see that on the schedule on the next slide. The total variable overhead costs are calculated by multiplying the units to be produced times the variable cost per unit, and the total fixed costs are simply going to be given because the totals don't change based on production. So let's take a look at what that schedule looks like. This is the manufacturing overhead budget for Jerry's Ice Cream. And again, this is the same information that we've been using for all the operating budgets that you'll see in the videos that I posted related to operating budgets. They're all Jerry's Ice Cream. All the numbers are consistent, so you can look across all these budgets and see that consistency. With the manufacturing overhead budget, we start again with the units to be produced, and that comes right from the production budget. We then break out our overhead costs into variable components, and you'll see that in this section, and fixed components, and you'll see that in this section. And we do it by quarter, as we've done with all of the other budgets as well, and then there's a total for the year. So let me just point out the first line item here, variable overhead costs for indirect materials. What we do is to find the cost for the first quarter, we take the 15 cents per unit that we expect to incur for indirect materials and multiply it by the number of units. And then that's going to give us the cost for indirect materials for that quarter. So if you look at 40,800 units times 15 cents per unit, you'll see that we have a total cost of $6,120. We use that same process for all variable costs. So I'll just go through that one, but it's the exact same process for all of them. Multiply the number of units for the quarter times the cost per unit. Then when we get to the fixed overhead costs, this here, fixed overhead costs, so up here we were just looking at variable overhead costs. Fixed overhead costs are simply an estimate of those costs for the period. They don't change with changes in production. So with salaries, if we predict that our salaries for the first quarter will be $15,000, then that's what it is. We don't factor in the level of production, assuming that we're within the relevant range here. And we assume in this example that those costs will be the same right on down the line for each quarter, 1, 2, 3, and 4. Same goes for rent, same goes for depreciation. So you'll see then that we have total fixed costs here. It's just those three costs added up, salaries, rent, and depreciation. And we have the same thing for variable costs up here. It's just the total variable costs added up. So indirect materials plus indirect labor plus the other variable overhead costs. So we break our costs out into the variable component and our fixed component for overhead. And then to get the annual information, what you see over here, we just take the sum of the line. Quarter 1 plus 2 plus 3 plus 4, whatever the data is for each of those quarters, and that gives us that total information. All right, one last piece here. At the very bottom of this, you'll see we have our total overhead costs, and that number is simply going to be, for example, in the first quarter, the total variable overhead costs plus the total fixed overhead costs. So the 20,400 plus the 35,070 gives us 55,470. And that's fine for our total overhead costs. And by the way, we use that same information to figure out the cost per unit down here of $1.20. We take the 240,480, and this is the second footnote that you see down here, and we divide that by, up here, the 200,400 units, and that gives us our standard cost per unit for overhead of $1.20. Now, the very last thing you see down here is simply the information that we're going to need for the cash budget later in a separate video. So we're going to subtract the depreciation since it was included above. We're going to subtract that because that's a non-cash item to figure out the actual cash that we have to pay for overhead. So that's what we're looking at in those last two lines, is taking the total overhead cost and subtracting our depreciation, and that gives us the cash payments for overhead, and that information will flow to our cash budget.